If you are looking for an indicator that will give you more precision in your entries and exits, the price and volume stochastic divergence could be a tool to consider. In this video, we will explain how this indicator works, what you can expect from it, and how you can use it effectively. Forget about empty promises. Here you will find only realistic and practical analysis. Let's start by understanding that the basis of the indicator is the cumulative volume delta, or CVD. The CVD is a tool that seeks to measure the difference between buying and selling pressure in the market. In its most basic form, it calculates the difference between the total volume of the green candles and that of the red candles. However, this is not traditional CVD. Here, volume is analyzed in a more intelligent way. This indicator does not count all volume in the same way. It assigns more weight to the volume generated in the body of the candlestick and less to that produced in the wicks. This is because it is the body of the candlestick that actually shows the price movement and therefore indicates stronger pressure. Take a look at the lines shown on the chart. The indicator is made up of 3 lines that represent different values: the CVD to measure volume pressure, the EMA for the price range, and the E delta for the trend. Each line has a specific role, and their interaction generates the signals we're looking for. The red line, representing the CVD, essentially displays the power of buying and selling pressure in the market. When the line approaches 0, it suggests that selling pressure is extremely strong, whereas when it approaches 100, it suggests that buying pressure is the dominant force. Additionally, the slope of the line reveals whether this pressure is gaining or losing momentum over time. The yellow line, which is an exponential moving average of the price. This line doesn't provide signals independently. Its primary role is to serve as a benchmark for spotting divergences with the red CVD line. In essence, the red line indicates the strength of volume, and the yellow line represents the price's position within a range. If the red CVD line shows increasing buying pressure, yet the yellow price line hasn't reacted to this pressure, it might suggest that the price is on the verge of rising. Conversely, if the red CVD line reveals growing selling pressure, but the yellow price line hasn't responded, it could imply that the price is about to fall. Finally, we have the orange line, which is the EMA delta. This line tells us the strength of the price trend. When it approaches 100, it indicates a bullish trend momentum. When it approaches 0, it indicates a bearish trend momentum. It is the confluence with the other 2 lines that signals the strongest entry points. Interpreting the signals is straightforward. The indicator displays red circles for sell signals and green circles for buy signals, but these alone aren't sufficient. We need to consider the other 2 lines. When the indicator shows a green circle, it's an alert that buying pressure is starting to pick up after a period of overselling in the market. This circle appears when the red line, representing the cumulative volume delta, rises from its lowest area, near 0, indicating that buyers are gaining strength. But this isn't enough on its own. We must confirm with the yellow line, which reflects the price's position within its recent range. If this line isn't falling, it means that the price is holding steady, supporting the signal. Additionally, the orange line, which measures the trend's momentum, should be above 50 to confirm that the bullish momentum has real strength. For sell signals, the process is reversed. A red circle appears when the red line falls from its highest area, near 100, suggesting that selling pressure is dominating after a period of overbuying. The yellow line, in this case, shouldn't be rising, which indicates that the price is losing its ability to recover. The orange line, on the other hand, should be below 50 to validate that the bearish momentum is active. These 3 lines work as a team. The circle is the initial alert, but the convergence of all of them adds solidity to the signal. A mistake would be to trade solely based on the circles without verifying the context. For example, a green circle near a key resistance, without support from the orange line, can be a trap. Another error is ignoring momentum. If the orange line is in a neutral zone, the signal loses reliability. The key is patience, waiting for volume, price, and momentum to tell the same story. To manage risk, always define a stop loss. For buys, place it slightly below the recent low. For sells, place it above the recent high. The take profit can target nearby technical levels, like resistances or supports, or follow a minimum risk-reward ratio of 1 to 2. Remember that even the best signals fail. Never risk more than you're willing to lose. In summary, the circles are the entryway, but the lines are the pathway. When volume, price, and momentum align, the probabilities are in your favor. But without alignment, caution is advised. The market rewards discipline, not speed. Take your time, always confirm, and let the indicator be your guide, not your master.